This is Debbie Hodgkins, and I'm here today with Jeffrey Kennedy, editor of Trader's Classroom. Welcome, Jeff.
Hello, Debbie.
You and our colleague, Wayne Gorman, wrote a book, Visual Guide to Elliott Wave Trading. It's part of the Bloomberg Financial Series. Could you explain why you and Wayne chose to write that book?
Oh, absolutely. One of my passions, well, actually, I have three passions, Debbie, teaching, trading, and technical analysis. And for quite a while now, Wayne and I both felt that the industry needed a book on actually how to apply the Elliott Wave principle from a trading perspective. Elliott Wave principle is written by Frost and Prechter, is absolutely a cornerstone to the wave principle, but that book primarily deals with the technique, the rules, the guidelines of the Elliott wave principle. Wayne and I both felt that what we needed, what the industry needed, and certainly what the Elliott wave theory does need, was more of a practical guide to actually how to apply the Elliott wave principle more from a trading perspective, real time, real money, that sort of thing.
Well, let's move on to a little lesson today. You've written an ebook on price gaps, and you periodically discuss them in your Trader's Classroom lessons. Could you tell me a little bit about price gaps?
Oh, of course, it's my pleasure. Well, price gaps, there's four types of price gaps. You have common gaps, breakaway gaps, acceleration gaps, and exhaustion gaps. Now, common gaps, they're really little of no value. They occur primarily during congestion zones or corrective phases. But the other three types of gaps, price gaps, are very important. The breakaway gap, the acceleration gap, and also the exhaustion gap.
How do price gaps help you as an Elliottician?
Oh, well, that's very easy to explain as well. As I previously mentioned, the three most important types of price gaps there are the breakaway gap, the acceleration gap, and also the exhaustion gap. Well, as an Elliottician, I've observed that there's a very specific placement of where those price gaps occur within an Elliott wave pattern. For example, as everyone should know, an impulse wave consists of 5 waves. Waves 1, 2, 3, 4, and 5. Now, what I've observed over the years is that typically within that 5-wave move, wave 3 is where the price gap tends to occur most often. So if you can just imagine a very small 1, 2, 3, 4, 5 for wave 1, well, your breakaway gap will most likely occur within wave 3 of 1. As wave 3 develops, and you'll see most likely a substructure of 1, 2, 1, 2, then your acceleration gap will most often occur in wave 3 of 3. Another example would be the exhaustion gap. That typically occurs within wave 3 of 5, and it actually denotes or helps you identify the completion of the pattern. In fact, I have some examples if you'd like to see them.
That would be great.
Excellent. Well, let me pull over a price chart here, and I'll show you an example of price gaps and how they help within the actual Elliott wave structure. Okay, now here's a price chart that I actually showed some of my Trader's Classroom subscribers a few weeks ago. And if you can see in this price chart right here, a big vacant space on the price chart. Well, this is actually an acceleration gap. But you'll also know a few other gaps on this price chart. For example, that price gap. Well, again, this is wave 3 of 1. If you work to the downside on the smaller time frames, you'll see a very small waves 1, 2, 3. So here's your price gap. This would be your breakaway gap. And then that gives you a complete 5-wave decline for wave 1. Then you see a wave 2 counter trend move up. And then the move to the downside unfolds also in 5 waves. And here's a nice price gap here. That gives you a wave 3 bottom. And currently, I believe we're now currently working a counter trend move, a 4th wave move. So what I'll be looking for as we move into, let's say, the final few weeks of March and into April, and possibly even as late as May, is another move to the downside that will most likely incorporate another price gap, which will be the exhaustion gap. Just kind of a simple rule of thumb, whenever you're looking at a price chart, and you see a price gap on a price chart like this, a big horizontal space, that's telling you that that move is a 3rd wave. And from there, you can actually piece together the larger operative Elliott wave pattern.
Well, how do price gaps help you as a trader?
That's really where the rubber meets the road. Well, the thing about price gaps is price gaps have a very strong tendency to be tested. And what I mean by that is when prices gap either up or down, Usually a period of time later, prices will actually come back and try and close that price gap. That's the term we use as technicians, closing the price gap. And it's this closure of the price gap, or this revisiting the price gaps, that often offer a very good trading opportunity for traders. For example, we'll just stick with this one price chart for the time being, and I'll show you a few other examples as well. Let me just show you a few price gaps on this price chart. Notice this move right here, the vacant space. That's a price gap. Well, here's the close of the bar preceding the gap. Notice how prices come back down nicely and attempt to close the price gap and then reverse. So as a trader, I'm simply, making a note that this is the move or the close preceding the gap, and then I simply wait, be patient, wait for prices to come back and revisit it, and then typically this is a good trading opportunity because I'm trading in the direction of the larger trend. Another example here, and this is how I combine traditional technical analysis with the Elliott wave principle. Here's a price gap again. We broke to the downside. Remember, this is the breakaway gap. We come down and then we advance correctively. This area offers a very nice area of chart resistance. Now, having said that, does that mean this fourth wave move is going to come up to this area right here and then reverse? No, absolutely not. This is just something I tend to look for on a price chart where it actually argues, or where I can find high probability trading opportunities. Let me bring over another price chart here. This is Yelp. YELP is the ticker symbol. And again, notice a few instances here on the price chart where prices actually come back down and close the price gap. And here's a good example. Now, that being the case, look at this price gap. This occurs in wave 5 of 3 position to the upside. So really my target to the downside, as this move unfolds down, I'm looking for prices to actually come back to, where would I be looking for? Of course, the price gap. This would be a nice area for the decline to unfold to, possibly bottom in wave 1 or wave A, and then give us a move to the upside in wave 2. Again, this is how I utilize price gaps in my work. And it's a great thing to be looking for, even on an intraday basis. Now, I don't have an intraday price chart prepared for you today, but this is, again, the very simple technique that anybody can actually utilize to identify these high probability areas or support or resistance zones where high probability trades tend to lay.
That's very interesting, Jeff. Thank you very much for the lesson. You can follow the link below this video to learn more about Jeffrey's Traders Classroom and how you can get a free copy of his book, Visual Guide to Elliott Wave Trading. Thank you, Jeff.
My pleasure, Debbie. Thank you.